Okay, now that we know that it is the systematic risk measured by the beta that determines the required return, what is the exact relationship between the two, between the systematic risk and the return that correctly reflects the amount of such risk? This is described in this big topic in finance, in corporate finance, known as the Capital Asset Pricing Model, or CAPM, CAPM. Okay, so we're talking about the relationship between risk, systematic risk to be specific, beta, and that's what we put on the horizontal axis, and return, or we're actually going to say expected annual return. So what investors should expect when they are buying a stock or a portfolio of stocks that have a certain amount of this systematic risk. Let's first mark our first point on this graph. The market portfolio. By definition, the beta of the market portfolio is 1. So somewhere randomly along the horizontal axis, we mark a point and we say that it's 1. And then for the market portfolio, with the beta of 1, there is some expected return for it. E, and in the brackets we put R and subscript capital M. M stands for market portfolio, R stands for return, E stands for expected. So we have this point, right? The market portfolio, point M. Then there is one more important point, R subscript lowercase f, RF, the return on the risk-free asset. From our last chapter, chapter 12, the risk-free asset was the short-term government bonds known as treasury bills or T-bills. Risk-free, in theory, means no fluctuations in return. So perfect predictability of what your return will be in percent every year. So even though in real life, even treasury bills like exhibit a little bit of fluctuations over time, we kind of simplify the reality a little bit and say that the fluctuations are 0, which means the standard deviation is 0 as well as the beta is 0. If the beta is 0, then this point, the risk-free rate, belongs on the vertical axis. And because the return on the market portfolio, on the risk-free asset is less than the return on the market portfolio, for example, we saw it in chapter 12 with the treasury bills, return on average being lower than the return on large company stocks. Because of that, the risk-free return is, below the expected return on the market. Then we have 2 points, and we can draw a line through them. In this textbook, we are skipping the explanation and the mathematical derivation that explains why the line needs to be straight rather than some sort of a curve going through these 2 points. So it has to be a straight line. And along this line, we can place all other stocks of all other companies, like Apple and Yahoo and Starbucks, anything you can think of. So this is where all other stocks should be. This is the correct relationship between how much systematic risk that particular asset has and what the required annual return should be that correctly reflects that amount of systematic risk. You can notice that the line slopes up and to the right, which means we are talking about the positive relationship between systematic risk and required return. And this is what you should have expected because of this phrase, high risk, high return. So the higher the beta, the higher the expected return. Okay, now let's talk about some math. So this is the equation for this CAPM model, the vertical intercept. So how do we calculate the expected return on any stock? So let's say stock I. The expected return on stock I equals, so what's the equation for a straight line? Vertical intercept, that's the risk-free rate, plus the slope multiplied by the beta, right? So the slope of the security market line turns out to be the difference between the expected return on the market portfolio and the risk-free rate. The name for this line is the security market line, or SML. That's the abbreviation. What else can we say about this graph? Along the vertical axis, we marked 2 points earlier, the expected return on the market and the risk-free rate. The difference between the two, whatever that is in percent, is the market risk premium. It's actually by definition. It's the risk premium on the market portfolio. By definition of what risk premium means, which we saw in our previous chapter. And for any other company, so let's say we have point I somewhere higher up beyond point M for the market portfolio. For any other company, we can calculate its risk premium by looking at the difference in percent between the expected return for that company, stock, and the risk-free rate.